The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
Good morning. Welcome to Money in the Morning, Monday edition. Money in the Morning with Mitch Goldberg. We thank you for joining us here at 103.9 FM, LI News Radio. A couple of things to get into. Again, this show is about you working hard for your money, so we want your money to work hard for you. And I like to say, if I can help somebody become a better version of their financial self, then I'm very happy. That's what this is all about. So we want you to put on your learning hat wherever you are, while you're driving, listening to us in your office, your home. And that's what the show is about. We begin the day with a futures update. The Dow futures up 26, the S&P up 9, NASDAQ futures up 55. So let's see that in percentage terms. Dow futures barely up, just a fraction of a percent. S&P futures are up about 0.25%. NASDAQ futures are up about 0.4%. Oil down just about 90 cents at 78.79, and the 10-year, which, you know, the biggest story last week was the 10-year yield at 4%, a little over 4%. First time that happened since last November. And, you know, the 30-year mortgage rate tracks the 10-year. So last time we saw mortgage rates in the 7s was when the 10-year went to 4. Makes sense because one tracks the other. But it looks like mortgage rates didn't quite get to 7, and the 10-year is actually below 4%, giving a little relief to Wall Street and helping the market continue its winning ways from last week. So last week was an up week. Major averages, I think the S&P was up like 1.5%, 2%. Nonetheless, it was an up week. The Dow is the only major average that is still a negative territory on the year. But you can't invest directly into an index, but you could invest into a security that tracks or mimics an index. So if you hear me say that every time, it's because I kind of have to say it, okay? So just bear with me, but we got that over with, okay? Mortgage apps were down last week. It was reported that mortgage apps were down to a 28-year low. Lack of inventory, lack of affordability, from anecdotal evidence of a few realtors I speak to, residential realtors, that, you know, some people are pulling back on the sale of their family home that they've lived in for a long time because they're worried that they're just not really going to get as much money as they thought they would get. I interpret that as people are getting so much money for their houses, and yet they're not getting as much as they thought they'd get, like a little greedy maybe. But so people aren't really in a rush to sell, but there's also a lack of move-up buyers because so many people have low mortgage rates, sub 4%, a lot sub 3.5%, that people are thinking, well, I'd love to be a move-up buyer, move into a bigger, nicer home, but you know, I'm paying 3% of my mortgage now. To go to a bigger home, I have to pay more money for the home, so I have to carry a bigger mortgage, and I'm going to get over, you know, like 6.5% mortgage rate. It's going to cost me a fortune to do this, a lot more money, and you know, it's just not worth the sacrifice to a lot of people to raise the expense of your monthly nut by a lot by being a move-up buyer. So we just have a lack of homes for sale. And even though home building nationally is going up a little bit, it's not really affecting our little region of the world on Long Island. We just don't really have the space to build like other parts of the country. But other the parts of the country that have built a lot, like Austin, Boise, houses in those regions are, you know, home prices are going down a lot. So it's just, you know, that's why we always like to say, you know, real estate is local. Okay, the housing market is local. Retailers have been painting a not so great picture of the consumer. You know, we've heard from Home Depot, Walmart, Lowe's, Target. Although Target was up, Costco, Target was up, they said, things are okay. But the stock had been beaten down before that. Basically, consumer demand is still there, but a lot of these retailers say they see signs that the consumer is struggling with higher prices, and consumers are still spending more money on experiences, dinners out, vacations, as opposed to electronics and apparel and housewares. Plus, Home Depot and Lowe's say that, when people are not moving into homes, they don't have that rush of spending to fix things up, paint, carpet, windows, doors, kitchen appliances, etc. So that stuff has slowed down. In fact, I saw Best Buy come down recently, like a week or two ago. The stock came down after earnings, and a good chunk of it is just people are not buying appliances as much as they were. So durable goods orders also reflected that. Durable goods orders, goods that last 3 years or more, were not so hot either. And CDs. So I'm on, if you want to know where you could look for CD rates, I'm on bankrate.com as we speak. And Synchrony is offering a 5% 1-year CD. People ask me, are these safe? Are these okay? If they're FDIC insured, they're okay. I'm sorry. Let me go back. Synchrony, it's a 14-month CD for 5%. Okay. But Capital One, which you all know Capital One, it's 5% CD, 11 months. So I see a bank called Forbright, 5.25%. Ally, that's for a year. Barclays, 5% for a year. BMO, 5% for a year. So there are rates to be had out there. And the reason I bring this up is because, number one, if you're sitting on cash and you want to leave your money in a CD, you've got some really good places to look if you know where to go. You might not get a great CD rate at your bank, but they are out there if you're willing to just do a little work, and it's not a lot of work, okay? But your big cash reserves don't need to be sitting in a low yielding checking account anymore. It wasn't a big deal because there were no yields to be had, but there are now. And so I just want you to be aware. Let's take a look at how things did Friday. The Dow is up almost 400 points. The NASDAQ was up almost 2%, up 226 points. S&P up 1.6%, up 64 points. The 10-year, again, right now, 3.91%. It was at 4% last Wednesday. The VIX, which we talk about, is below 20. And I know this might not sound right to you, but I follow the market so closely. This has been a very low volatile year with everything going on. Ukraine, Russia, relationship with China becoming more adversarial, it seems by the day. The stock market's been pretty tame this year. I mean, we've had a couple of multi-hundred point up and down days, but not a lot. I know it's only March 6th, but so far it's been a pretty tame year. So a couple of other things that I want to take a look at is some personal finance stuff. When you pay down credit card debt, and you're hearing in the news a lot more that people are relying on credit cards, but cash is up also. So it's tough to say people using credit cards because they're carrying balances. More people are, yes, not like it was in 2019, or people using credit cards more and more for the points, things like that. But however, if you have debt to pay down, we either use the Snowball approach or the Avalanche approach. And the one that's better is the one that you could stick with. The Snowball approach is when you have, let's say you have 3 credit cards, each with a balance. You attack the credit card with the lowest balance first, because it's the easiest one to attack. And when you get that balance down to 0, it gives you momentum to attack the next one. I'm a huge believer in the Snowball approach to reducing debt. Avalanche means you pay off the debt with the highest interest rate first. That is actually the most logical because that's the most expensive one, so you want to get rid of that debt. But it's harder to see progress if you're not getting something going to a zero balance. So we talk about Snowball, we talk about Avalanche, disciples of Dave Ramsey, and I agree with a lot of things he says, and I don't agree with a lot of things he says, but he is a big advocate of the Snowball approach also. So the idea is to just, once you start getting momentum and a good feeling about your progress in your financials, you are encouraged to do more, and you start to enjoy it. You start to become obsessed with it. And that's what it takes to make financial progress. It's not easy. It's not easy all the time. At some points of your life it is, some points it's not. You're listening to LI News Radio 103.9 FM. I'm Mitch Goldberg. This is Money in the Morning with Mitch Goldberg. Stay tuned. We'll be right back after these very brief and informative messages. Welcome back to Money in the Morning with Mitch Goldberg. We thank you here at 103.9 FM LI News Radio for joining us. I sure as heck know that I thank you and I appreciate your time. The stock market looks to continue its bounce from last week. Is this the market finding its new winning ways? We'll see. The market did hit some key support levels, technically speaking, last week. And right on cue, it bounced off of those. And that gives short-term traders, momentum traders, a little bit more confidence to stop selling and doing some buying. And once markets lift a little bit, the next trader says, gee, maybe I should buy a little. Then the next trader says, I should buy a little. And it starts to become a nice little cascade of buying. And that's why we go through these ups and downs short term. And that's why it's important to follow technical analysis, the technicals, because it helps you understand, the charts. It helps you understand what the short-term trading is all about. It's something that people try to, use to try to make money. Some people are successful with it. Some people aren't. And in the world of trading, if you're right, 53, 55% of the time, you're actually one of the most successful traders. That's how thin the margin is, and that's why it's so hard to trade. Remember, when you're buying or selling a stock, you're trading against somebody else, and often that person you're trading against could be a hedge fund, it could be Citadel, it could be Goldman Sachs. Okay, you don't know who you're trading against, but generally speaking, I win the trading game personally by not trading. It's like, how do you be a winner as a gambler? By not being a gambler. Unless you're having fun. But there are those people who could, gamble a little bit, but they can't stop. And if that's your issue, then I hope you will seek help. That's my public service announcement for the day. But I win as a trader because I don't trade. I invest. I look for the long term. I've been telling you, I'm not worried about 2023. I'm worried about 2028, 2033. That's what I'm in this for. And that's where I believe I will earn the greatest returns and, beat inflation, have a boatload of money when I'm older. I kind of feel like I am older. I'm 55, but when I'm a lot older, how about that? Now someone's going to be like, oh, dude, 65 isn't really that old. I understand. I'm going to be here when I'm 65. All right. I'm not going anywhere. I love what I do. I truly do. Somehow I picked the exact right career for me, and it's morphed. I started in 1990. The industry I'm in is so different that it's not even like I'm in the same industry anymore. And that keeps it interesting. It's the best it's ever been for the clients. The clients have such a great deal going now with Wall Street, with their choices of investing and service and planning. It's just really so great. Like, you want to be a do-it-yourself investor, you've got more resources than ever. You want a financial advisor. The financial advisor community it's just the best it's ever been. It's truly become a wonderful profession where it's fiduciary. The clients get a fair shake. That, I really, we all know we couldn't all say that 100% about the industry, 30 years ago. But today the industry is the best it's been. And myself and all the financial advisors I know really work so hard to further the industry, to further the public confidence in the industry, to further their own education, their continuing education, and to keep educating and teaching the clients. And if you see the content made, there's so much content being made now by individual financial advisors. It's not just a mutual fund company writing a report with a spell check and a professional writer or something on TV. It's guys like me, and girls. Okay. So, financial advisors like me who are just putting out a ton of great educational content with a lot of perspective. What can I tell you? I love the way the industry is going. So, we've got CD rates pushing 5% for 1 year around the country. Go to bankrate.com. That will help you find them if you don't see them at your bank. You have the interest rate complex of the 6-month and 1 year T-bills a little over 5%. 4 months T-bill is a little over 5%. But it does feel to me that the interest rate moves up, which was so strong for the last couple of weeks. It looks like it's topped out a little bit in the last week or so. So most of the yield curve is down. You take a look from the 1 month out to the 30-year, almost every T-bill, note, bond, Treasury security yields have been coming in since late last week, which does give a lot of impetus to investors buying the market. We also spoke about paying off debt, deciding between the Snowball and the Avalanche methods. The Snowball is when you pay off the smallest balance first, you try to get some momentum, you feel good about getting one of your debt balances to zero, and then you attack the next biggest one and the next biggest one. And that's the way to build momentum. I'm a huge believer in momentum. We are emotional creatures. We like to build our self-confidence, and it's amazing how much more we can do when our confidence is up. That's why we teach our kids so often to have confidence, which is, not such an easy thing. And then there's the Avalanche method, which is logical. You pay down the highest cost debt first, and then the next highest cost. That's good, except it's not always a way to build momentum unless your smallest credit card balance is also your highest yielding debt. And I'm not talking regarding mortgages, by the way. And I want to say to you that overwhelmingly with mortgages, my clients who are made for successful retirement, those who are prepared to financially take the leap, overwhelmingly, these clients have completely paid down their mortgage by the time they're in their mid-50s, if not sooner. Overwhelming. It's not even a question. So those are the most successful clients, the ones who actually reach the goal of retirement. Why do they do that? Because even if your mortgage rate is 3%, you're still paying down that monthly amount in principal. And what my retiree clients like to say is, I want my expenses to be so low that even if I had to do something part-time, there would still be more than enough to pay for food, electricity, and real estate taxes. These are people who I'm quite sure will never have to go to work again for the rest of their lives because they're successful. However, that's why it's so important to pay down a mortgage at some point before you retire. And at that point, getting your Social Security money doesn't just go to a mortgage, it goes to you. Now, we've been talking about Social Security a lot, and some of the proposals that I've been talking about have been maybe raising the full retirement age from 67 to 68, maybe extending from 70 to 72, the highest rate you could get for Social Security. And I started to think in terms of, there's different reasons why people claim their Social Security at different points in their lives. If you listen to my community, the financial advisors, we are always going to tell you to at least wait till full retirement age, which for most people listening now is 67. Some of you at 66. And even then, we want you to wait till you're 70. It's just like standard advice. But it also depends on how your health is, things like that. Man, I have so much more to say about Social Security. But just because you have a relative or a parent that had a premature death from an illness, it doesn't mean you're going to, and our medical technology is so much better. So with diagnostics and all that, there's a good chance you won't suffer the same fate. So it's more of a discussion about, is Social Security an investment, or is it a plan to help you have more money in your later years? We'll talk about that tomorrow, okay? You're listening to 103.9 FM, LI News Radio, Money in the Morning with Mitch Goldberg. We covered a lot of topics today, but I love it. I hope you enjoyed the fast pace and all the education. Stay tuned for the next homegrown show, and we are so grateful for you joining us today. Have a great day.
Securities and investment advisory services are offered through Next Financial Group Incorporated, member FINRA SIPC. Client First Strategy is not an affiliate of Next Financial Group Incorporated. All the views expressed are those of Mitchell Goldberg and Client First Strategy and not those of Next Financial Group Incorporated. Views are general in nature and not intended to be investment advice. Any discussion of individual securities should not be construed as a recommendation or solicitation by our presenters. Next Financial Group Incorporated does not provide tax advice.